This afternoon, I'm joined by Robert Lloyd George, who is Chairman and Chief Investment Officer at Lloyd George Advisory in Hong Kong. Robert, welcome to Money Talk, and thank you for joining us today.
Well, thank you, John. Good afternoon. It's always a pleasure to talk.
Well, I'd like to key off your excellent investment outlook for March 2016 entitled, Has Globalization Peaked? To start, would you be kind enough to give our listeners a snapshot of your extensive investment career and your perspective on the evolution of globalization from 1979 when Margaret Thatcher gained power?
Well, John, and you and I are almost the same generation, and I started work in the City of London in 1974, and therefore we can, I think, compare what it used to be like, and if you like, the ice age of globalization before investors were able to diversify internationally, and after 1979, when, as I said, Mrs. Thatcher took the first step to allow British investors, and I think the American institutions were also moving offshore in those years after the interest equalization finished in the 70s and the ERISA legislation was introduced. So there was suddenly a wave of capital which really reached Europe and Japan first in the 70s and early 80s. And then in the 80s, when I moved to Hong Kong in the beginning of the 80s, we saw this wave of capital extend into Singapore, Hong Kong, Taiwan, Korea, and eventually into India, China, and the emerging markets in the 90s, because both China and India really changed the tack in about 91 with Deng Xiaoping's To Get Rich is Glorious and Rajiv Gandhi opening up, really as a result of very low foreign exchange reserves. So both countries needed foreign investment. They made it easier for foreign investors to come in, and they were the two big markets that we have focused on the last 20, 25 years. And we've also looked at frontier markets and all those. And I think there's a sort of limit that's been reached when you look at places like Africa, Central Asia. I mean, what is investable? Are there good legal and foreign ownership limits in place? Is there safety for investors? And are there, compelling reasons to buy companies in those areas? And I think there's been some sense of a recoil now. And does it make more sense to own multinationals listed in New York or Toronto or London? And I think there is still a case for emerging markets, but it's not growing as it used to a decade ago. There's very clearly been a change of the atmosphere now, I think.
Today, are we witnessing the beginning of the end of globalization? And what are your thoughts on the current state of the Chinese economy and marketplace?
Well, I think it would be a mistake to say that globalization is definitely ending, because, there are still enormous global trends in place, and China is at the center of those. China has multiplied its wealth by something like 10 times in the last 20 years, has become a major exporter. And the question we really have to ask ourselves is China's export boom coming to an end? And it maybe is slowing down. And I do think that the renminbi will have to correct probably by next year, and that China will experience slower growth domestically. But having said that, here is the second largest economy in the world. There's more billionaires in Beijing than there are in New York now. There is still, when you go to Shanghai, a tremendous consumer boom going on. So we shouldn't be too gloomy. There are lots of opportunities within what is overall slower growth, more like Europe or the United States type of 3, 4, 5%, not 10% growth. So I don't think it's all bad news, but I do think we need to be cautious. Clearly, the old economy, the commodity-intensive economy, oil and mining and construction and real estate is slowing, but the consumer, internet, travel, tourism, those sectors are still going gangbusters. So, we see a divergent trend, really, and China is also exporting capital. And every day we see news of another big deal where the Chinese have bought, for example, Starwood Hotels this week. They're clearly buying land and agricultural land and commodity companies all over the world and brand names. So that trend, I think, will continue for some years to come.
Robert, now it seems only natural to move on to the investment potential that you see in India in particular and the Indian subcontinent in general.
Well, everyone always contrasts China and India, but they're very different animals. But having said that, India's growing at 7 to 8%. Its demographics are much more favorable than China. They're going to overtake China with 1.3, 1.4 billion. They're a young population. They haven't had any artificial controls on their birth rate. And I think that it's a free, open, and capitalist economy where there are a lot of middle-sized companies and smaller companies. I was down in Bombay and traveled around India in January. We saw a lot of internet startups. We saw a lot of companies in the consumer and entertainment and travel space, and we think this is probably the most exciting emerging market with good fundamentals. And we're looking at mid-cap companies in the sort of 2 to 5 billion market cap range. And to give you a flavor of those, I mean, I saw Z Entertainment, which is a big TV and broadcasting company, and I was fascinated to learn that they broadcast in 10 different languages around India. And it's got all these regional franchises, which are very strong in terms of advertising, and Indian young population just getting into this consumer advertising space. And then we saw some auto parts companies, some internet startup companies in recruitment and software, and very similar to Facebook, Amazon, Netflix, those sort of companies starting up in India. So I think India has good fundamentals, pro-business government, strong rupee, good central bank, good earnings growth, 15 to 20%, good economic growth. And for all those reasons, I would counsel investors to take a 2 to 5 year view on India and say, this is a country where things are getting better. It's not dependent on a slowdown in U.S., Europe, or China. It has its own momentum. It's a beneficiary of lower oil prices and commodity prices generally, and it really has good, strong fundamentals. So I think we will make money there, and that would be my main bet for the next 2 years.
And I understand that you were in Australia recently and that you have some observations that will resonate with our Canadian listeners.
Well, yes, I think there are parallels between Australia and Canada. One shouldn't push them too far, but both the currencies are commodity-linked and have corrected against the U.S. dollar by some 30% odd. And clearly in Australia, they were even more, I think, dependent on the mining sector, exporting to China. And that sector has fallen by about 70% in the last 2 or 3 years, to the extent that today the real estate sector in Australia is now a bigger contributor to GNP than mining and energy. And the surprising thing to me is that actually with this fall in the Australian commodity sector, the economy is still motoring along. They haven't had a recession for some 20 or 30 years. And there are a number of areas like healthcare where I think there are some very, very good companies, and they are indeed developing products in the Australian domestic market and then taking them globally. So I saw one of our smaller companies, Nanosonics, which is a maybe $500 million market cap, and they do equipment for hospitals, desanitizing hospital equipment through ultrasound. And it's worked very well in Australia. They're now expanding in the U.S. and in the U.K. and Europe. And I think that the chief executive was formerly at Cochlear, which makes ear implants. And that was a company which had a fantastic track record. And so I see good stock-picking opportunities in Australia. And, of course, it has the transparency, the Anglo-Saxon accounting standards and all that, which mean that you have the exposure to Asia, but you have the good management and some comfort in knowing the people that you're investing with.
Let's conclude with your overview on markets and interest rates. Now, excluding American politics, are we getting back to normal in that old-fashioned stock picking is proving its worth over an automatic allocation to the nifty FANG shares?
Yes, John, I definitely feel that there is a swing back to stock picking and to dividend achievers, to sound balance sheets and strong consumer franchises. Having said all that, I think that the background is still uncertain. Obviously, geopolitics is one factor. The American election is another. Britain possibly pulling out of the European Union. I hope that all those things will work out better than we expect at the moment, and that we won't have protectionism, and that free trade remains the cornerstone of growth. But I worry a little bit, and this is jumping ahead to my next month's investment outlook, that we may see a surprise in the markets this year of inflation actually picking up again. And I think maybe that's a topic for our next month's discussion, because it obviously will impact interest rates and the dollar and commodity prices. So for the time being, I see a lot of opportunities in Asia, but I'm still cautious about the macroeconomic background.
Robert, thanks so much for joining us today, and we'll look forward to talking to you next month and receiving your